We're celebrating more than 2 million Canadians choosing Fidelity. And to say thank you, we're giving you a chance to win a branded Fidelity hoodie. Enter by visiting fidelity.ca/hoodie-contest. At Fidelity, performance is more than a number. It's progress, confidence, and momentum. So choose performance, choose advice, choose Fidelity. Now, here's today's show.
Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Canada's economy has entered a technical recession, and with most of the second quarter behind us, it is still probably too early to tell how fully markets are pricing all of that in, if at all. Our next guest says with all of the geopolitical uncertainty that's unfolded through this year so far, investors are treating markets a little bit like a glorified casino, with short-term moves masking perhaps what's really happening underneath. So where should advisors lean in? What's being misread? And how is he positioning portfolios for opportunities beyond the headlines? Joining us here today for a mid-year check-in on global equities and the forces shaping markets is Fidelity Chief Investment Officer and Portfolio Manager Andrew Marchese. Reminder just that today's webcast features live French, Mandarin, and Cantonese audio interpretation. Welcome, Andrew. Great to see you. Thank you for joining us.
Great to be here.
A very exciting moment to have you here to ask a few questions. We'll invite everyone joining us here to send questions in for Andrew over the next half hour or so. Can we just begin with getting the technical recession thoughts on this? It's a couple of quarters in a row, not looking so great. There's other things going on though. What do you think?
Yeah, what I'm more concerned about is the corporate profit backdrop globally, which looks, it started the year looking very good. It's actually gotten better. I'm more concerned about that. I mean, if you go back about 10, 11 years, we were in a global profits recession, even though the economy was not ringing recession, was kind of fine. So you can have the opposite. I'm more concerned about profits. That's what actually fuels us from an investing perspective and kind of sets the foundation for opportunities to invest in.
Okay, so we'll leave it for now in that sense and sort of let it be a little bit. Give us a view of the world, the pieces that you're looking at. We'll take a look at all of them, but there's lots of geopoliticals we're talking about. I want to ask you about inflation that goes along with some of the geopolitical story. If you had to rank sort of three risks that are out there that you're aware of, what would they be?
Yeah, I think you start with the fact that on the positive side, as I said, the global profits engine is coming into the year doing very well and accelerating, but we've priced some of that in. So valuation is never a catalyst for a correction, but it does make you wary in certain areas of the market, not all areas. So capital will go where you can kind of exploit a valuation discount, or buy growth at a discount to other growth, which is already being priced in for a blue sky scenario or a perfect scenario. So that's one aspect. I don't look at that holistically, for the market as kind of painting it with the same brush. I think it's all about finding and exploiting opportunities to invest in a disproportionate way. That's one of them. I've always maintained that the conflict in the Middle East is transient. It will resolve itself. Certainly, we would like the Strait open more sooner than later. It's probably gone on longer than it should. And the longer it goes on, that poses a risk to a supply shock to commodities. And that has, a knock-on effect to the economy as we kind of progress into the second half of the year. So that deserves to be monitored. And what are the ramifications for that from both a consumer demand perspective, so discretionary purchases, and what does that mean for industrial manufacturing margins, right? So your input costs go up, generally speaking. Could that mean that margins fall and then earnings have to be negatively revised in the back half of the year or even into the first half of next year? So that would be the other risk. This goes on too long, and at some point the market kind of says, okay, we've maybe been complacent on this issue from a pricing perspective, and we need to kind of price it accordingly. It's a smaller risk, but a risk nonetheless.
Really interesting. But the backdrop being that companies are earning more, and it's been astonishing to watch the earnings story play out. Much more on that. When you link the story of sort of a short-term ism in the markets. We mentioned the casinos, which actually I think comes from you. It's sort of a feeling of that's in there. Again, that is sort of a short-term story. You're looking longer. But discuss the phenomena and really what it does to markets, maybe the psyche of markets and investors' maneuvers.
Well, sometimes you find that capital will flow into things that do make sense from an earnings perspective, but the expectations down the road get priced in for some kind of real blue sky or perfect scenario. And people are unaware that some of this stuff is actually cyclical. It's a CapEx cycle like every other CapEx cycle. We have all read and done research on the fact that it is, one of the most exciting and maybe most lucrative CapEx cycles that we've ever seen in history. That being said, all good things must come to an end at some point. So the important thing to remember when investing is try to engage when that point will come. And so we've seen, hundreds of billions of dollars invested into the area of artificial intelligence. By all accounts, that may be going up in the year or 2 years to come. But at some point, that number does start to decelerate. And historically, when that number decelerates, then the market treats it very negatively. So we just have to be aware of that. I think also with that and the amount of liquidity that's in the system, you get speculation in certain areas of the market where business models are not yet well-founded, they're not robust. Companies don't have really much of a hope of earning what their stock price would say they're going to earn. So speculation is all part and parcel of that. So it's all, some of the stuff is legit with real businesses, with real revenue and cash flow and profits, and other parts is more hope. And you see, every time we go through a market cycle, in particular, if you have one or two themes that really kind of break away from the path, you're going to get that. You're going to get that kind of euphoria, and maybe things aren't always well thought out. So you get pockets of what you term to be the casino aspect of it all. People thinking they can't lose in a certain area. They treat it all kind of homogenously, and that's really not a great way to invest. It can work for a short period of time. You benefit from an investment perspective thematically, but eventually things get parsed aside, and only the true companies with long-term robust business models, great capital allocation stories, their stocks kind of survive and go forward.
You've spoken before that, and I think maybe over the course of several years at this point, that the world is going through a deglobalization after globalizing for 20 odd years. It's reverting, probably started in COVID, the supply chain story. Take Canada as sort of a case in point, ultimately, for investing within it. But what it is doing right now to react to that, is trade a huge part of that? How is Canada sort of making sure that within that deglobalizing world is doing what it needs to do? How do you see that?
I see kind of Liberation Day as April 2nd of last year as kind of the Minsky moment for nations to kind of move forward in a different path, and the catalyst to think differently about their economies going forward. So Prime Minister Carney has talked about the middle, and the middle having to make new trade alliances. We, as the U.S. has embarked on more of an isolationist mentality, their hopes really, I think at the end of the day, for a weaker dollar. You've seen governments all over the world try to reduce their exposure to the U.S. dollar, whether that means selling U.S. treasuries or buying gold as kind of a hedge against all of this. The world is changing. It is a slow march. And the question I've often got is, if there was a new administration post-2028 in the U.S., would that change anything?
Right.
History would tell you it's actually slow to reverse, despite the intentions of somebody. So I think, as our Prime Minister said, it's incumbent upon us as a nation to figure out a way to form new trade alliances and grow faster than we have in the past. Maybe we haven't been as optimal on that front as we could have been, and now we don't have the benefit of certainty with our partners to the U.S. And so, like anything else, I think necessity is the mother of all invention, kind of thing. So I think to that kind of point, I think April of last year kind of forced the hand of a lot of countries around the world. So So to the extent in Canada and other nations around the world with respect to natural resources, what you have in the ground is going to become increasingly important. Your ability to spend both on the public and the private side is going to become vitally important to make sure that your nation is equipped to deal with those new trade alliances. In Canada, what does that mean? New pipelines, maybe it means changing laws with respect to the ports in British Columbia and shipping goods out. It can mean all of that. It could be investing in the defense industry or the aerospace industry or any number of new innovative industries to make yourself, you have to rely on yourself to a greater degree. And I think April of last year put a spotlight on all that.
With the defense industry, if you sort of go back in history and read all the histories of how wars and defense spending comes up, it's often to protect the assets that the nation has itself, as much as the people and the borders. It's also what's inside. You mentioned those things that are in the ground inside the country broadly are going to be worth more. Just sort of take us there from an investment perspective. How do you lean in to that?
I think if you look at the last natural resources bull market, which happened between 2000 and 2010, there was a lot of consolidation that happened globally. Right. So the assets ended up in the hands of fewer players. There's fewer ways to invest in this publicly. But as we know, as commodity prices rise and things that were once not economically feasible from an exploration perspective become economically feasible. So to the extent that new capital comes into the mining industry or oil and gas industry and any one number of commodities, and those things now meet the merits of, well, it actually does make economic sense to go mine for this. Companies are going to be looking to do that. Mm-hmm. And there are fewer companies than there were just 20 years ago to do that. So there's a scarcity value around that. To the extent that those assets are in safer geopolitical places in the world, they're probably inherently worth more just based on that.
Sure.
So that puts Canada in a great spot.
So you mentioned there aren't as many companies because of consolidation last super cycle time round. There are lots of companies, and we saw the TSX go up massively last year because of the resource stocks, broadly speaking, certainly the gold side of things. Are we going to see more companies get made? Is the environment there, the landscape there for new companies to come public?
History would tell you yes. If you embark down kind of a broader secular, I don't want to use the word super cycle, but a secular cycle, then yes, all those projects that were once not economically viable maybe become economically viable, and companies will look for capital to exploit them. So there'll be more issuance, secondaries. There may be more IPOs going forward. So that's what history will tell you occurs during these types of cycles. So
it's exciting.
Yeah, it could be.
It could be really exciting. What do we need to know, going back to sort of the short-term side of things, about rates? I mean, some of that's going to be expressed long-term as well, but inflation and rates, everything that you're discussing costs money to get it rolling, and it, in theory, is inflationary for a period of time anyway. How do you protect against that as you're building out what you're discussing?
Yeah, I think about inflation more from a secular perspective than a cyclical perspective. And I think the question becomes is the growth of M2 money supply over the better part of the last 25 years or so, and the mere fact now that you have as I said, a supply shock to the system. If we become more fragmented as a global economy, what kind of stress does that put on from an inflationary perspective? And you're seeing some of that in the bond market, and yields are rising accordingly. Now, I think, to some degree, it's kind of interesting when you see bond yields move up, the tech names actually move up with them because
this is interesting.
For two reasons, I think. One, they can kind of outgrow, some of them can outgrow
the yield
story. But the other one is a lot of thought that the CapEx happens outside the general economy. So they're going to grow independently, right? So
they're not selling to the general economy if it goes up or down, collapses or whatever.
If you think that bond yields and inflation eventually slow an economy, as an investor, you seek out growth. growth opportunities that can grow independently over the overall economy. When you have tailwinds at your economic back, you seek out more value, things that are more cyclical, that need a strong economic tailwind behind you to kind of get an increase in demand and so on and so forth. And that drives the P&L of some of those cyclical value-oriented names. But so that kind of explains the behavior on a day in and day out basis when tech's doing a little better and bond yields are reacting as such. So I think about, I think we've had some people, on this forum and other forums to suggest maybe we're never getting back to 2%. The question is, do we kind of lurch into longer
term inflation,
higher inflation? And that will be the big thing to ask ourselves. And that kind of dovetails into what Yuri and Timmers talked about with a 60-20-20 diversified portfolio.
Good. Okay. So with alts sort of breaking up the bond side of things a little bit. Alts can be many different things, and Fidelity offers alternatives to take advantage of things generally within stock markets. What else is in there from sort of a global perspective of what belongs in that other 20?
Hard assets to preserve any negative ramifications that come from inflation. So I agree with Yuri, and that 20% should come from fixed income. And it's not a prediction in as so much as it's a probabilistic exercise that with all the money supply, with everything that's going on in the geopolitical landscape, there is a non-zero risk here that we just lurch and grind forward from an inflationary perspective. And what does that do to bond yields longer term? And so for all the reasons I mentioned with respect to the world is changing and you want assets in the ground, so to the extent that they're hard assets, industrial commodities like nickel and copper and the like, diversification away from the US dollar. If the US really wants a weak dollar, and I think they do, then the hedge on the other side is gold. What does it mean for land, arable land?
Get into the agriculture piece of this.
Right. And that was a theme we heard way back, in the early 2000s as well. So some of these things kind of come back, and it's all because of the changing landscape, the abundance of money out there in the system, and the knock-on effect would then be there's a non-zero risk here that's inflation just kind of grinds higher. Now, the opposition to that viewpoint would be artificial intelligence and other technological advances.
We'll take care of it.
We'll take care of the inflationary aspect of it and dampen it down so we don't need to worry. We'll be able to exist in a 2% CPI world because inflation will take care of any undue pressure that is caused from an inflationary perspective. The other thing, just to kind of finish up on the inflationary front, is you start to get into this kind of world of people talk about affordability versus inflation. So if you talk,
it's two separate things almost.
Yeah, right. So if you talk about affordability, then affordability is really much more of a gross problem than inflation is. And so how do we address affordability for certain assets that we need to live in? If you're talking about the regular CPI, you're not talking about a lot of things that affect consumers on a day in and day out basis. And is it more appropriate to look through things with that lens as opposed to the garden variety statistics around CPI?
So there usually is an investment for that to make sure that you have some pricing flexibility. You could either go through dividend strategies or you have other ways of investing to sort of help you with some of those.
Absolutely.
But is it fair to say that you look at the world as that possibly, or at least probably being a way you should look at your investments, that inflation is, it's there, it's here, might be around for a while?
Yeah, I think you get a partial hedge through equities. Obviously, fixed income, you have potentially a very deleterious effect if inflation runs rampantly. Bond yields back up a lot, and then the ultimate is just you have that 20%, invested in commodities, hard assets to a degree, and that kind of gets you through. So I think you treat it, kind of under that scenario, 80% of your portfolio, 60% you would have a partial hedge, 20% you have a pretty decent hedge. And If it doesn't come to fruition, you still have the strategic importance of those hard assets,
Right.
because it's, longer term, if we're becoming less global, if the deglobalization theme continues to march forward, any way you cut it, those have strategic importance, whether or not you think of it as a inflationary hedge.
What does, we're approaching obviously the sort of various dates for the Kuzma discussions and final dates and so on. What does trade look like? You can use Canada as an example. In a world like that, there's still going to be trade. I mean, people are still putting things on lots of great big ships that are all over the world and sending them across the world. It's still there, but it looks different.
Yeah, I look at Kuzma as like you're trying to solve a problem for the here and now. All these alliances, this alliance that we have in place, and the flow of goods that happen across these borders. Somebody threw down the gauntlet. Now we got to go back to the table and figure it all out. That's a here and now problem, and I don't know how it gets resolved. But yeah, you're going to figure it out in some way, shape, or form, and it probably results in no one party being exceptionally happy, but everybody can kind of just go, okay, we're mostly the way there.
Does it resemble what we have?
I have no idea.
Okay.
And I'm very quick to point that out.
Yeah.
We don't know. We're not privy to those discussions and what have you. But the bigger one, I think, from an investment standpoint, is coming back to the new alliances that are formed.
Okay.
Right. And so you deal with the here and now, but the growth, the future, is based on everything that this country and others can do with each other in a way, for whatever reason, we didn't pursue before. But maybe, as I said earlier, the Minsky moment occurred in April of last year, and it requires a very strict, disciplined approach to a new strategic way of thinking about the country. And hopefully we address that. It's going to take many, many years, if not decades, to do it. But I'm more optimistic on this country than I've been in a long, long time. And I think we have
It's really cool.
I think we're not only saying the right things, but there's signs that we're doing the right things. But I think you have to remember, this takes a long time.
Okay.
You're not going to see it immediately. The Kuzma stuff, you see it more immediately.
Okay, so there's a journey here, but there's ways to invest it, which you've addressed. There's a couple of questions coming in on the impact of the three quite well telegraphed big IPOs that are coming, the excitement around them. I might ask you sort of a question on that, but more broadly, what's the market effect? You got these behemoths coming in, it's pretty exciting. What should investors know about it sort of around the edges and maybe for investing within them?
I think just from a market mechanics standpoint, you're right, it creates a lot of euphoria. You get more supply.
Right.
You may, in situations where there is a lot of excitement and high valuations, flows move in that area, and as a result, you got to sell something to buy something.
Potentially within the equity markets.
Right,
Yeah.
so you cause a price dislocation in other aspects of the market, which for the patient and the astute could be a great buying opportunity, right? So I think that it's very interesting from a liquidity perspective. If you back out the investment theses for the companies that are being issued, and you really look at it from a liquidity standpoint and the cause and effect, it's always very interesting to see what else is behaving the way it is, because that's where the opportunities. You can run with the herd if you want to, and that's fine. There's plenty of people who do it, and there are plenty of people who are successful at it. The more intriguing thing for those who are patient and diligent can be: is there anything else being sold to buy what's being issued? And
it's a great company.
Right, great company. It got dislocated, and now when I look at it, I can be patient, and my 5-year compounded annual return will be tremendous. And like I always say, like those are the ones that are interesting, because you just have to make one decision, which is buy it and wait, as opposed to be kind of almost like a high frequency trader to a degree, and the other stuff. Yeah. It
goes back to sort of the casino nature that we're seeing in some areas of the market. Let's go back to one of the geopolitical discussion points that you were talking more about. The Straits of Hormuz need to open, the oil story there. Lots of thoughts on don't chase oil when it was, circling up. It's still, up high. What happens on the way down, or where it could land? I mean, is it a land of opportunities, really, is the question.
I think the question is, how does the whole situation get resolved? Does it get resolved in a somewhat messy way that everybody is not quite pleased with? And so do you have an embedded war premium in the price of crude going forward? Right.
Okay.
So you don't.
It could always flare up again, sort of thing. Right.
Yeah, or just like it's messy, where nothing is operating like it used to. Things are operating, but it's not as efficient and painless as it used to. And so you would have some kind of premium embedded in the price of crude for that reason. So I think that's basically kind of my
The
take on
concern
crude.
there.
Yeah.
Okay. All right. So it's sort of. So in the meantime, you got to have a balanced approach. I mean, is that sort of you can't really.
I've been doing this for 28 years, and my approach has always been balanced. It make less decisions, not more decisions. It's easy to get caught up in the euphoria of certain aspects of the market, and that's been true. I mean, every year that I've spent here at Fidelity, like there's always something really running or thematic in nature, and you just got to kind of always remember that balance generally wins. And I always think of it as your investment is kind of like you're flying a plane to get somewhere, and ideally you want kind of as little turbulence as possible. Right.
Land gently.
Yeah, right. It's fine if we get you there, but if we get you there in like a bumpy and all over the place way, that's not a fun ride. And when it's not a fun ride, I think you're more apt to make less optimal decisions. So I think from that perspective, yes, the return matters, but also the path to return matters.
That's very good to be reminded of that ultimately. Let's go in just quickly to sort of inflation, but the rate story. So we've got someone new at the Federal Reserve. Lots of interest around that. I think everyone knows the headline stories there. It's really the direction of rates from here. We hear a lot about the US. They'll just sit on hold. They're high enough. It's not like they came down to rock bottom. Other parts of the world did come down in a rate cycle, cutting cycle, much lower. So what's your rates outlook? Give us a few countries, broader take.
So when we started the year, Jan 1st, I think the US was kind of the outlier in saying, we haven't cut enough. We would like to. And I think since the conflict started in late February, and we're seeing some of the economic numbers continue to get better in North America on the manufacturing and service side, combined with all the discussion we had about inflation earlier, job market's fine. You can't really point to cutting anymore, right? That's been a stepwise change. So now the question is, for a lot of economists out there, and they're not only with the respect to the United States, but other countries, who's going to tighten first and by how much?
Well, Australia, apparently.
Right, Australia did it, right. And so who goes after them and by how much? So I think really for many developed nations right now, market implied policy outlook is for flat. Don't touch it, wait for something to develop. But the bias, I think if you took a sample size of economists out there, the bias is towards tightening. But that's basically, one could point to the inflation argument, but the other argument is growth has been good.
Growth has been good, right.
Particularly in North America.
Right,
so,
which is a good reason to hike, says Denise Chisholm, for instance.
Well, yeah, if you start overheating, then you have high oil plus high growth. There's probably a good reason to say the bias is towards tightening. I think
the economy can handle it because there's growth.
You would think so. And the only way that argument fails on itself is probably if there's a material downgrade in kind of employment. If employment numbers, for whatever reason, were to kind of come undone, then it's hard to kind of justify that. It might keep you on the sidelines a little longer.
Do you want to finish up with just sort of the long-term opportunity of AI in the markets? We've all been looking at it. There's certainly the story of the resources that go into making sure we can power it all. And we all know about data centers. But what's the opportunity as an equity investor right now in AI? We're a couple of years in now. Long way to go, though.
I think what's been very clear since last year is that the AI theme has outperformed the broader market. Right? So But even within that AI theme, the leader has been the semiconductors and chip space, right? So that reminds me a lot of 1999. It was the equipment guys that we all knew were cyclical, but you wait for the CapEx to kind of
peter out,
exhaust itself. Well, right now and people point to a shortage of supply and fabs and the ability, and you're always going to have more chips and need more chips and so on and so forth.
Endless demand there.
Endless demand, and not price sensitive at all from the people who are buying these things. So it paints a very, very blue sky like backdrop. As I said, we know all this ends, and then the longer term, multi-year beneficiaries of it still remain to be seen who they are. So I always like to kind of, just think to myself, in 99, 2000, we talked about WorldCom, Nortel, Qualcomm, Dell, Cisco.
Some of them are still around.
So I was going to say Qualcomm,
well.
I think, is the only one we still really talk about in terms of being a nouveau company, even then. But we talked about those companies. But the real beneficiaries of the internet build-out were none of them. And some of them weren't even companies at that point in time, and some of them were privates who didn't have more to a shingle to their name. And so you have to wonder if artificial intelligence will be the same way. Will it spawn new industries, new companies that are
the real winners, ultimately.
And maybe that's it. Maybe so the winners right now are quite apparent and evident before us. Are they the winners in 10 years? Time will tell.
We need to have a chat ongoing about that one in particular. Andrew Marchese, thank you for enlightening us, bringing your views and insights.
Thank you.
Fidelity Connects.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.